What's wrong? Okay, there we come again. All right. All right, so position size formula. You need to start an account. Your capitalization has to be correct, minimum of $3,000. Then you can go ahead and trade with a minimum of 5 mini lots. Now, let's just go over two things. One is your position sizing based on your formula. Second is your risk to reward ratio. Everything in trading is tied to money management, right from your technicals, the analysis. Oh, the Boyki, that is a standard formula. So for a standard account, it's E divided by 2,500. For a mini account, it's E divided by 500. For a micro account, it's E divided by 500. Somebody else has invented it. -1, that's right. So E divided by 500 into bracket, the entire thing -1. That's the formula. Now, if you want, I can send you this Excel sheet with the formula. You need not, you can just go ahead with this, not a problem. Right? This particular position sizing, because what I have done for my traders, I have put in a position sizing, I have put in leverage. Understand what leverage is all about. This is because the leverage is often a very misunderstood concept. And then this is something, as I said, I trade with myself. I still, whenever I take a trade today, I use this Excel sheet for myself. I take time off, I fill up this Excel sheet and see to it. Just for example, now this is reserved only for the subscribers, of course, but just as an example, let's say that I have a starting capital of $10,000. This 10,342 was from another trader of ours who's in the room, and we were calculating this. He was looking at a GBP trade or GBP buy. So we fill in this. Your price is 1.5850. This is what you're planning to buy it at. Yeah, sure. Just give me your send me your email in case you people don't have. Of course, you have my email, but I'll just put down my email over here. If you can send me an email, I'll send you the Excel sheet, at least for the position size formula. Right? So I can give that to you. It's a standard thing. It's available everywhere. I've just fed it in the formula. Coming back to this, so what I do is, if I have a capital of $10,000, for my trade, my stop loss is, let's say, 30. My profit target is 50. And my spread, taking into account the particular spread, it gives me the risk to reward ratio. So it is 1.67. If it is less than 1:2, I do not take the trade. Now that's the mind factor which comes into it, which says that if the trade, it's looking good, the technicals are looking good. And if it does not conform to my money management principles, I will not take the trade. The second part is, based on this requirement or based on these parameters, I have the number of position size over here, lots that I can trade. Accordingly, if I have $10,000, I could trade 19 mini lots. But what is more important is the maximum risk of capital. Let's say that I go ahead with 19 lots. I'm just showing you something. If I go ahead with 19 lots, my maximum risk of capital goes to 5.88%, which tells me don't trade. I need to keep this at 2%. So I reduce this. If I put it down at 5 lots, that's a max that I would probably take. And this is, believe me, I do this for every trade. This also calculates automatically the leverage over here. The leverage, the margin is carried forward, the leverage is related to the margin, so it's all interconnected. Anyway, as I said, I just wanted to show this to you. What I want to discuss more over here is related to money management. Your capital is related to your trading capital, is money management, risk to reward ratios, position sizing, even the time frame that you are trading in depends on your capital. You see, you do not choose your time frame. Your time frame should be decided by the amount of capital that you have. Now, to go ahead with this, it's a very important concept which a lot of traders again do not look at, and regardless of the capital they have, they select the time frames, which you should. Right? If you're a day trader, you have time, you're sitting in front of the computer throughout the day, you can day trade. You go ahead and trade on the 5-minute and the 15-minute. If you're doing something else and you are a longer term trader like I am, I would rather trade on the 4-hour and the daily. Minimum to the 1 hour. I generally don't go below the 1 hour. I decide this, I need to have that much amount of capital. Let's do some simple calculations based on the trades, a couple of trades, 2-3 trades that we had taken, and I just want to show those to you. Right? Can you see the charts? Okay. All right. Now let's have a look at this. Now this is a daily time frame. Let me start off with the daily time frame, and I just want to correlate your technicals to your money management. This is a bearish harmonic pattern on the Euro USD on the daily time frame, something which we took short. Right now, this is a trade that we took was short. Just give me a moment. It was this. Oops. I need to change the color of this one. I need to put a dark blue color. Yeah. This was a short that we took. Alright, this was a short. Now, after this price went up, but I've kept this chart image over here because there's something which I wanted to show it to you. So, clear all annotations. Go. Right. Let's have a look at the risk to reward ratios of this one. Your risk on this trade, the entry was, let's take it at a round figure. Round figures on a longer term time frames do become important. 1.3060 was your entry into the trade. The stop was at 1.3140. Right, so we are talking about a stop loss of 120 points, correct? Roughly. So, no, I'm sorry. We are talking about a stop loss of 80 points. Let's just do these calculations. 80 points is your stop loss. Now your expected target, this is your harmonic patterns are based on the Fibonacci ratios, and this Fibonacci ratio was, the target was 1.27, a FIB projection 127.2. Let's keep it round as 1.2700 round. The 127 was at 1.2711. So 1.3060 minus 1.270, right? You had a profitability of 360 points. What is your risk to reward ratio? 80 was your risk, your reward was 360, which is close to 1:5. Now this is one more thing. If you have trades which give you a risk to reward ratio of more than 1:3, you can see, you saw on the simulation, you just keep trading, that will probably become a billionaire, right? That's what the simulation says. Right, Jeremy, I'm just coming down to that. How do you know which time frame to trade with less than 200? It's all on these mathematical calculations, the capital that you have. Let's take this particular example. What was my stop loss? My risk to reward ratio was good. This trade went good. We made good money. It's never really a question of money. Everything was as per procedure. The trade went very nice. Right? It was an excellent trade. Let's concentrate on the stop loss. My stop loss on this was 80 points. Now, we generally go in with multiple lots. I would recommend 3 lots as a minimum. You should never go in with one single lot because it does not allow you to maneuver your money management positions. So if I'm going in with 3 lots, I have single lot of 80. So my total risk is about 250. Now, let's say that I had $10,000 in my account. $10,000 divided by 240, let's say it's 240, my total risk on this was about, what, 2.4%? Am I right in my calculations? Right? Which just about fits into this. Which means, now this is where I'm coming from, Jeremy, that if I'm trading on larger term time frames and I have to keep a stop loss of 80 points into 3 lots. Let's say my total risk is 240. I need $10,000 to trade on these larger term time frames. 2% of $10,000 is 200. My risk here is 240. It just about fits in. Now you do the calculation, Jeremy, that if you have $2,000, what is 2% of $2,000? 40, right? You will say 40. So your total risk is 40 points. If you divide this into 3 lots, I would always recommend going with 3 lots. I'll just come down to that point, which means that your average stop loss for your trade is about 15 points. Into 3 lots is about 45 points. 45 is 2% of your 2,000. Now, 15 points is a very small stop loss. which means that you have to trade on a very small term time frame.